Futures is actually a tool for any investor or traders to anticipate what is going to happen. Never a bad strategy, only when a person is not disciplined enough.
I'm sure many of you heard of futures market trading before, but at the same time, you guys also feel that it's a bit foreign because not many of us actually deal with this asset class. But increasingly, especially with the market volatility increasing day by day, more and more people are dwelling into the futures market. But to me, I have been investing in stocks for a while now, but I have very little experience in futures. And to help me to understand the asset class better before I put money into it, I've asked help from Affin Hwang Investment Bank to help me to better understand what is futures, to find out whether and see whether I am able to stomach that kind of risk. Once everything is in place, then I'll probably allocate some of my funds to go into futures trading to try it out myself. And in order to help me to understand equity futures, I've invited a guest to help me to understand more about this product. Without further ado, let's go and have a chat with her. So in the past, I think Malaysia only got the KLCI index futures, you have the palm oil futures.
Correct.
But recently there's also becoming more and more interesting because CME is coming into Malaysia with all their equities futures products, right?
Yeah.
Maybe you can help us to understand further what are the products that came into Malaysia.
Actually, CME came in not so recently. They were here like back about 10 years ago. It's vibrant. Definitely it's vibrant because all over the world is trading in the CMEs. Everyone is looking at Dow Jones, they're looking at Nasdaq, they're looking at S&P 500, That's so far it will say that that's the benchmark of how, the economy is, stuff like that, yeah.
Yeah, but subsequently their products also became more and more creative in the sense that they come up with like E-mini contracts, like micro E-mini contracts.
Correct.
So today, are all these things also tradable from maybe Affin Hwang Investment
Yes,
Bank?
definitely.
Okay.
Because coming from a retail perspective, right, if you're talking about the e-mini contracts, the margin is slightly bigger. But when we are targeting on, if let's say we're talking about retail traders like me and you, I call myself a retail trader, it makes it more available, reachable for these retailers. So subsequently, the contract size is smaller, the tick size is smaller, so it means that the margins that we have to put in is relatively lower. So it's easy, accessible by retailers.
Oh, so it's mainly a retailer product, this
Mainly
micro
is, yes, the micro e-mini is mostly for, suitable for the beginners when you want to start up, especially someone who fresh grads. But youngsters, they don't have this capital. So one of the ways is that this is easy, accessible for them as a start.
Volatility is the word to describe the global markets in 2024. Heightened geopolitical tensions, climate change, and unexpected economic shifts have thrown the markets into a whirlwind, creating uncertainties that left many investors feeling uneasy. However, for seasoned investors, volatility isn't something to fear. It's an opportunity. Because whether there's volatility, there's potential for profit, especially in futures trading. I've mostly been investing in stocks, but with the potential I see in futures trading, I'm eager to dive in. The only thing that's holding me back is my limited knowledge. That's why I turned to Affin Hwang Investment Bank and CME Group, where I connected with industry experts who share invaluable insights. Jose taught me the skills needed to trade oil and gas futures. Elaine revealed her tricks for using a trading journal to learn from past mistakes when trading index futures. And then there's Nanda, the master trader who successfully navigated two major market crises in 1997 and 2008 when trading palm oil and soybean oil futures. Even Peter from Mr. Money TV got curious about futures trading and interviewed Kelvin Ho, the head of derivatives at Affin Hwang Investment Bank. If you're interested in getting started with futures trading like us, check the link in the description to open a trading account with Affin Hwang Investment Bank. By the way, I'll be joining Affin Hwang Investment Bank's event on the 25th of September 2024 at 6 o'clock in the evening, where I'll be moderating a panel with the experts that I've interviewed. We'll be discussing how the upcoming US election could impact the futures market. I know it's a weekday, but light dinner will be served, so don't miss out. Check out the link to sign up now.
In general, right, how do you see this equities futures product? Because I can just buy ETFs. So what's the difference between an ETF and, let's say, a S&P 500 futures?
In a way that if, let's say, you were talking about ETF, yes, there's a lot of ETF, there's a lot of, there's spiders out there.
Yeah.
But the difference for the futures itself is that you only need to look into the indexes. That's it. You don't have to look into the baskets of shares. You don't have to study into too much in depth. Right? So if you want to have your exposure as a whole, relatively, let's say for example, I want to look at the US markets. How is their movements, their economics, stuff like that. But I do not want to delve too much in depth into like nitty-gritty of all those small, counters and stuff like that. Then might as well I just look into the futures itself and then I'll just go into it. And another thing, futures you can go in, shorter terms. They will more in the sense that they will look into tradings into the futures in a shorter terms because some news, for instance, announcement.
For instance, like FOMC may cut interest rate in September.
Exactly. Yeah. So, stuff like that, when people buy into futures, they buy into, can I say this? They buy into rumors, right? And they sell on the fact. So when news like this, so you just buy into futures, that's it. It's faster.
That's the thing, right? We seldom hear the word futures investor. We always say it's futures trader. So maybe in some sense, you are explaining to me that it is more of a short-term kind of exposure towards an asset, and therefore futures is a more suitable product instead of equity ETF or something like that, where people just buy and hold for the long run.
I would say so because you see, futures and other asset classes of investments tools is a little bit different because futures contract has expiry. That's why the name it calls that futures, because you are buying into a futures pricing. So there will always be an expiry. So it's more on a shorter term strategy compared to if we are buying into stocks, we are buying into ETF, then that would be on a longer term. So it depends on the investor's appetite or trader's appetites. But then again, it depends on which type of traders or investors you are. If let's say we are talking about those hedge funds or we talk about unit trust funds, some of them, they do hedge their risks into the indexes as well. For them, they might do it in a mid to a longer term because it's totally different because they're hedging against their portfolio risk.
But how do you hedge for long term when your contract expires in September, right?
You can, right. That's always the questions where clients will ask how you do that. Basically, you can still do as well. It's rollover. We call it rollover in the sense that, for example, let's say take for example, now we are the month in January, okay? We are in January. So you buy into a January contract. So you buy into a Dow Jones Index, January contracts. So it's going to expire on the 31st, right? So once it's expired on 31st, you can actually roll your contract over, means you close your contract and then you reopen your contract on the second month, means on February.
Okay, so if I understand this correctly, if I enter into a January Dow Jones contract, to roll over, I have to sell that contract on the 31st of January.
Yes.
Immediately, I buy a February contract.
Correct.
At the same price?
No, it won't be at the same price.
Oh, so there's always a spread that I need to risk.
Yes.
So you have seen a lot of traders. I would like to ask, right, what is the most common mistake that these people make?
I would say that one of it is overconfidence. Clients that comes and then they start asking you that, how much money I can make? Overconfidence.
That's the wrong question to ask also. Whether they understand the specification of the contract.
Exactly. But this is one of the most common questions that I will ask clients coming, from the retail clients. And then when I talk about overconfidence is that, especially when clients, they start winning trades. When they started off and then they have winning trades, winning trades, then
right, you feel invincible.
You're like so invisible, you're like Superman, and then suddenly there's kryptonite coming and then you're dead, right? So when traders, they're overconfident, this is what happens. Another one is that I would say that they are so biased towards that, how do you put it? A very good example, they are in a short position where you're predicting the market's going down, okay? They are in a short position. Good news keep coming, but they would just, filter out.
In denial.
Yeah, in denial, and then they will just filter out that news and then keep thinking that no, the market is going to go down, the market is going to go down, the market is going to go down. But eventually the market actually went up. Okay, things got good. So this is one of the other biases that these traders that they have the mentally the mindset that they're always in denial of themselves. And another one I would say is that overexposure. They over calculated their risk.
This one I can explain through my experience.
Wow. Okay, come, let's hear from you.
You correct me if this is what you are trying to explain. Is that you know how futures has this margin, right? You only need a fraction of the funds in order to get the full exposure.
Correct.
So instead of, let's say for example, I want to have one full unit of exposure into the Dow Jones Index.
Yes.
If I go into ETF or whatever, it will be like a certain price, the full price.
Yes.
But when I go into the futures market, I need maybe 5 to 7% of the funds.
Exactly, yes.
But I already prepared that full price in the first place.
Yep.
So instead of saying, hey, now I buy 1 unit of exposure to index, I use the same amount of fund, I put all in, now I got 10 times the exposure. Then I can make 10 times the money, ma.
Yes.
Right? Correct, right?
Correct.
Yeah.
So this is what happened to the clients as well.
I see.
It's the same things when you talk about
That's
margin.
the mistake I made, yeah.
Yes, that's oh okay.
That's the mistake I made.
This is what happens to a lot of traders. I call them traders, not investors, because a real investors, they would have calculated their risk properly. If let's say today I only have 100,000, then I would calculate my risk based on my 100,000, but I have to still minus off a lot of things. So meaning that if I have 100,000 and I would want to trade into one lot of, let's say, Dow Jones Futures or Nasdaq Futures or S&P Futures, I will not use my whole capital of 100,000, right? Because like you mentioned just now.
Just now we talk about shorting position. In hedging strategy, I can understand. In the commodity market, I can understand because sometimes economic conditions become not so favorable to the commodity, then okay, I think the commodity price will go down, I short it.
Yes.
But there's always a saying in the equities market, right, is that equities is always on a going concern and it will grow over time.
Yep.
So technically speaking, there's only one way for equities, which is up. Now, when you trade equities futures, you're trading an asset class where the assumption is that it will forever be one direction. So if you're short, technically speaking, you are always wrong. That's my assumption. Can you help me to clarify then why people would still want to short the index? Because knowing that over time, a short position is always wrong, at least in equities.
To answer you that, I will give you an example of one of my clients. He holds huge amount of unit trusts and shares. He always says that, Elaine, don't call me any other day. Don't call me every other day. It's very annoying. Only call me when you feel that the market is doing not so good and slightly going into a negative zone. Okay, if I were to pull out a chart today and I were to show you on Dow Jones itself, yes, relatively, if you look at if you unzoom
out,
it,
maximum.
you zoom out, then you will say that it's always a one straight line up, right?
Yes.
But if you were to zoom in and then you to enlarge it, it's not always a straight line up. It's always a up, zigzag, zigzag, zigzag. So this is what happens when this client of mine, he's holding tons of unit trusts, but you only ask me, only call me when the market is going down because he only want to short the market.
Maybe that's his hedging strategy.
Yeah, that is a hedging strategy. So you have clients that when you mention that equity is always on the way up, but there's always a downtime as well.
Okay, so now let's zoom in, right? Zoom into no need to go too long, just until the end of the year. And a lot of people are speculating that the Fed may finally cut the interest rate in September. And at the same time, in November, we are going into the US election. Now everyone has the opinion that maybe Donald Trump may win after Biden had a disastrous debate with Donald Trump, right? So with all these events playing out and you are in the equities futures market, do you wait for all these things to react in the market, then only you take a position? Or do you position yourself now with the anticipation that these things are going to happen?
Remember the beginning part where I did mention that people will always act during the speculations. They speculate when things haven't happened yet. So as a futures traders, I will start take action now, not until when the decision is out.
Is that your strategy or is that in every futures trader's blood?
Every trader's blood.
Okay.
In a way that why we call it futures, because there is always a reason, because it is a futures forward pricing. It's a future price where we are indirectly predicting, crystal ball, of course not that crystal balls predicting kind of thingy, but then again we are anticipating something is gonna happen. If situations A is gonna happen, what decisions I'm gonna take? If situations B gonna happen, what are the measures that I need to take? So futures is actually a tool for any investor or traders to anticipate what is going to happen, and then you start reacting today. Another way of trading would be you look at charts. What the charts tells you, that's how you take your actions.
I think no matter what strategy we all take, right, I think the most important part is still risk management.
Correct.
So because I have very few experience in futures trading, and so maybe I can learn from you, what should I do in my risk management to become a better equities futures trader?
I would say that for an equity futures trader, one of the things that you need to have discipline. And I will always ask my clients to have your own trading journey journal. For example, of course, definitely you will need to have a trading strategies, then you go into the trading, right?
Yeah.
So once, let's say, for example, you already have your trading strategy. So what you need to do is that every single day, whatever trades that you put in, okay, whatever decisions that you want to make, just jot it out. And from there, you will realize that where is your mistakes. But a lot of people, when I say that they're overconfident, it's because that they never self-reflect what actually went wrong in their trades.
That's interesting. I never thought of having a trading journal. I think I've learned quite a bit, and it gives me even better understanding about futures trading. But before I let you go, right, maybe you can give me another piece of advice so that I don't lose so much money. Yes, so number one, don't be overconfident, that one for sure. Number two, keep a journal. This is something that I never done before, so I'm going to give it a try. Maybe you can give me one last piece of advice.
Discipline. Discipline is a must. And when I say discipline, I'll give you another scenario. I have a client of mine that has been with me for the past 10 over years. But the funniest thing is that he has a very good trading strategy where he shares with his family members. The trading strategy with the family members, every one of them make money except him because he wasn't disciplined. He never stick to his own strategy. He keep improvising, because when you have a trading strategy, when the signal asks you to sell, you sell. When the signal asks you to cut loss, you cut loss. The signal asks you to buy, you buy. So you need to be very disciplined in follow through your own strategy. Never a bad strategy, only when a person or a trader is not disciplined enough.
All right. Thanks very much. I had a very enjoyable conversation with you. Find you again 2 months later. I'll show you my journal.
All right.
All right. And then we see lah.
Yeah, we cross-check again.
Cross-check again.
Okay,
All right.
great.
All right. Thank you so much. Thanks,
Thank you
Elaine.
so much.